Chapter 8. Reporting and interpreting property, plant and equipment, natural resources, and intangibles. The optimal level of investment in long-lived assets is often difficult to determine. Insufficient investment results in inadequate capacity to meet consumer demand. Excess investment results in unused capacity, wasted resources, and excessive expenses. Part 1. Long-lived assets are assets that are used actively in the operations of the business and that are expected to benefit the operations into the future. There are two major categories of long-lived assets. Tangible assets are long-lived assets that have physical substance. Intangible assets are long-lived assets without physical substance. Part 2. There are three major categories of tangible assets. The first is land, which is not depreciated. Next are assets that are subject to depreciation, such as buildings, equipment, furniture, and fixtures. Depreciation allocates the cost of a long-lived asset over the periods benefited by its use. We will study depreciation in detail later in the chapter. The third category is natural resources that are acquired for extraction of valuable raw materials that will be used in the business. Examples include oil reserves, timber, and other minerals. Natural resources are subject to depletion, a process similar to depreciation. We will review the accounting issues related to all three of these categories in this chapter. Part 3. Intangible assets are non-current assets without physical substance. They have value represented by rights that produce benefits. Patents, copyrights, trademarks, franchises, and goodwill are examples of intangible assets. We will take a look at each of these later in the chapter. Intangibles with a definite life, such as patents and copyrights, are subject to amortization. Intangibles with an indefinite life, such as goodwill and trademarks, are not amortized. Amortization, similar to depreciation, is a process of allocating cost over an asset's useful life. Part 1. The fixed asset turnover ratio measures how effectively a company manages its fixed assets to generate revenue. The ratio is computed by dividing net sales by average net fixed assets. Fixed assets include land, buildings, equipment, and natural resources. Net fixed assets are fixed assets less accumulated depreciation or depletion. Part 2. Consider the following example for Southwest Airlines. Southwest Airlines had $9,861,000,000 of revenue. End-of-year net fixed assets are $10,847,000,000, and beginning-of-year net fixed assets are $10,094,000,000. Let's calculate fixed asset turnover for Southwest Airlines. Part 3. Southwest's fixed asset turnover is 0.94, meaning that Southwest generates 94 cents of revenue for each dollar invested in fixed assets. Part 4. By comparison, you can see that two other airline companies, Delta and United, have higher fixed asset turnover ratios than Southwest. Part 1. The acquisition cost of an asset includes the purchase price as well as all costs necessary to get the asset in place and ready for its intended use. We record the purchase price net of any cash discounts taken. Finance charges are not included in the cost of an asset. If we elect to finance the purchase over a period of time, the interest cost is charged as an expense when incurred. Recording acquisition costs as assets is referred to as capitalizing the costs. Part 2. In addition to the purchase price of a building, the acquisition cost includes legal fees, realty fees, title fees, and renovation and repair costs necessary to get the building ready for its intended use. Part 1. Equipment is recorded at its purchase price less any available cash discounts. In addition to the purchase price, the cost of equipment includes sales taxes, delivery charges, installation costs, and any building modification costs necessary to accommodate the equipment. Part 2. When purchasing land, the cost includes the purchase price, legal fees, surveying fees, broker's commissions, and other costs generally incurred in connection with the purchase, such as taxes and recording fees. As noted earlier, land is not a depreciable asset. Part 1. Let's see how to record the purchase of an asset. Our first example will be a purchase for cash. On January 1st, Southwest Airlines purchased aircraft for $70 million cash. Let's prepare the journal entry to record the transaction. Part 2. We debit flight equipment and credit cash for $70 million. Now, let's look at an example where Southwest purchased aircraft by using a note. Part 3. On January 14th, Southwest Airlines purchased aircraft for $70 million, paying $1 million in cash and issuing a note payable for the remaining $69 million. Let's prepare the journal entry to record the transaction. Part 4. We debit flight equipment for $70 million, credit cash for $1 million, and credit notes payable for $69 million. Part 1. Companies sometimes acquire operational assets without paying cash. In any non-cash acquisition, the components of the transaction should be recorded at their fair values. The first indication of fair value is the fair value of the consideration given to acquire the asset. Sometimes the fair value of the asset received is used when that fair value is more clearly evident than the fair value of the consideration given. Let's look at an example. Part 2. On July 7th, Southwest gave Boeing 9 million shares of $1 par value common stock with a market value of $5 per share, plus $25 million in cash for aircraft. Let's prepare the journal entry to record the transaction. Part 3. The fair value of the stock given by Southwest is known since the shares trade on the New York Stock Exchange daily. Southwest gave shares of stock worth $45 million and $25 million in cash for the aircraft. To record the transaction, we debit flight equipment for $70 million and the sum of $45 million and $25 million. Then, we credit cash for $25 million, common stock for its total par value of $9 million, and additional paid-in capital for $36 million, the difference between the $45 million market value of the 9 million shares and the par value of $9 million. If we construct a tangible asset, such as a building, the cost will include all the necessary construction costs, material, and labor, plus a reasonable amount of overhead, and any interest costs on money borrowed to finance the construction. After a tangible, long-lived asset is purchased, a company may incur additional expenditures on that asset. These expenditures may be for repairs and maintenance, overhauls and upgrades or additions. Generally, subsequent expenditures for ordinary repairs and maintenance are expensed in the period incurred. These amounts are called revenue expenditures. Subsequent expenditures that are for betterments, like overhauls that extend the life of the asset, and additions, are capitalized instead of expensed. These amounts are called capital expenditures. The decision to capitalize an expenditure results in higher current income and higher current taxes. A revenue expenditure charges the amount to expenses in the current period, resulting in lower current income and lower current taxes. In many cases, there is no clear line distinguishing between revenue and capital expenditures. To solve this problem, many companies have policies regarding the expensing of all expenditures below a certain amount according to the materiality constraint. Part 1. Depreciation is a process of cost allocation. We allocate the cost of the asset to expense over its useful life in some rational and systematic manner. Do not confuse cost allocation with asset valuation, an economic concept. The unused portion of the asset's cost appears on the balance sheet. We allocate a portion of the cost to expense on the income statement each accounting period. Part 2. The current year's depreciation is an expense on the income statement. Accumulated depreciation represents the depreciation taken on the asset since its purchase and is deducted from the asset's cost on the balance sheet. Part 1. Regardless of the method used to calculate depreciation expense, we must know three amounts for the asset. 1. The asset's acquisition cost. 2. The estimated useful life of the asset. And 3. The estimated residual or salvage value we expect to receive at the end of its useful life. Once these three amounts are known, we select the depreciation method that we will use to calculate depreciation expense. Part 2. There are three popular methods of calculating depreciation expense. The easiest and most widely used method is called straight-line depreciation. In special circumstances, we may wish to use the units of productions method. We would elect this method if the life of the asset is generally measured in terms of units of production. For example, airplanes keep highly detailed records of engine operating hours. The unit of production may be operating hours run for an aircraft engine. The third method is called the declining balance method. Under this method, we take more depreciation expense in the early years of the asset's life and lower amounts of depreciation in later years. Several income tax depreciation calculations are based on the declining balance method. Let's begin by looking at straight-line depreciation. Part 1. Depreciation expense for any given period is determined by taking the asset's cost less its estimated residual value and dividing this amount by the asset's estimated useful life in years. Let's look at an example. At the beginning of the year, Southwest purchased ground equipment for $62,500 cash. The equipment has an estimated useful life of 3 years and an estimated residual value of $2,500. Calculate depreciation expense for the year. Part 2. This calculation was relatively easy. Did you get the annual depreciation of $20,000? Now, let's look at depreciation for this asset for its 3-year life. Notice that depreciation expense is the same amount in each of the 3 years. If we plot this amount on a graph, it would be a straight line. That is how this method got its name. Accumulated depreciation increases by $20,000 each year. The cost of the asset, $62,500, less accumulated depreciation at the end of any year, is called book value. Book value decreases by $20,000 each year. The book value is equal to the estimated residual value at the end of the asset's useful life. We want this to be true regardless of the method we use. About 95% of companies responding to a recent survey reported using the straight-line method for some or all of their assets disclosed in financial reports. Now, let's move on to the units of production method, Part 1. Using the units of production method, the first step is to calculate the depreciation rate per unit of production. To do this, we divide the asset's cost less its residual value by the total estimated number of units that will be produced by the asset during its life. Part 2. Once we complete the first step, we may calculate depreciation expense for the period by multiplying the depreciation rate per unit that we determined in Step 1 times the number of units produced in the current period. Let's look at a specific example. Part 3. At the beginning of the year, Southwest purchased ground equipment for $62,500 cash. The equipment has a 100,000-mile useful life and an estimated residual value of $2,500. If the equipment is used 30,000 miles in the first year, what is the amount of depreciation expense? Let's follow our two-step method of calculating depreciation expense for the year. Part 1. First, we calculate the depreciation rate per mile of use and find it to be 60 cents per mile. Part 2. During the year, Southwest recorded 30,000 miles of use on the ground equipment. So we determined depreciation expense of $18,000 by multiplying 30,000 miles times 60 cents per mile. Let's look at a table of depreciation expense for this equipment over its life. Remember that we need to know the miles of use in each year. Part 3. In the second column, we see the miles for each of the 3 years. Depreciation expense amounts for each year are determined by multiplying the miles for each year times the depreciation rate of 60 cents per mile. The accumulated depreciation balance is the sum of all depreciation expense, including the current year. Book value is the acquisition cost of $62,500 less the accumulated depreciation. Finally, notice that the book value at the end of the third year is equal to the estimated residual value of $2,500. Now let's move on to the declining balance method. One of the reasons to consider the declining balance method is that it is an attempt to match depreciation expense and repair expenses to focus on the overall cost of ownership. In the early years of the asset's life, depreciation under the declining balance method is high, and generally repair expenses are low. Conversely, in the later years of an asset's life, depreciation expense is less, but repair expenses are usually higher. So, over the life of the asset, we attempt to equalize the total cost of ownership each year. Part 1. Calculating depreciation expense under the declining balance method is a two-step process. The first step is to calculate the double declining balance depreciation rate. We do this by dividing 2 by the useful life in years. We can convert this number to a percentage by multiplying by 100%. Next, we determine depreciation expense by multiplying the double declining balance rate times the asset's beginning of the period book value. The double declining balance method ignores estimated residual value. Let's continue with our Southwest example. Part 2. At the beginning of the year, Southwest purchased equipment for $62,500. The equipment has an estimated useful life of 3 years and an estimated residual value of $2,500. Calculate the depreciation expense for the first 2 years. Don't forget that residual value is not used in the double declining balance method computations. Part 1. Here is our double declining balance method equation. Calculate the depreciation expense for the first year before advancing. Part 2. At the start of the first year, the book value of the asset is its acquisition cost of $62,500. For the first year, to determine depreciation expense, we multiply the book value of $62,500 times the double declining balance rate of 2/3 and find the depreciation expense of $41,667. Part 3. At the start of the second year, the book value of the asset is its acquisition cost of $62,500 minus the first year's depreciation of $41,667. To determine depreciation expense, we multiply the book value times the double declining balance rate of 2/3 and find the depreciation expense of $13,889. Let's look at a depreciation table for our asset. While we always want the book value to be equal to estimated residual value at the end of the asset's useful life, it just will not work properly using the double declining balance method. As you can see, the book value of the asset at the end of the third year is $2,315. It should be $2,500. The only way we can make this work is to force depreciation expense in the last year to be the amount needed to bring the book value down to the $2,500 estimated residual value. Let's look at a corrected schedule. In the third year, depreciation expense is limited to the amount that will reduce the book value to the estimated residual value of $2,500. For the third year, we will record the depreciation expense of $4,444. We determine this amount by subtracting the residual value of $2,500 from the book value at the end of the second year, $6,944. Part 1. If an asset's value decreases and cannot be recovered through future use or sale, the asset is considered to be impaired. An impairment can be the result of a casualty, obsolescence, or the lack of demand for the asset's services. Part 2. The impaired asset should be written down to its net realizable value, resulting in a loss being recognized. Part 3. A business may voluntarily dispose of an asset by selling it, trading it, or retiring it. A business may also dispose of an asset involuntarily as the result of a casualty, such as a fire or accident. Part 1. When we dispose of a plant asset, the first thing we do is update depreciation to the date of disposal. After completing the update, we can record the disposal with a journal entry. Part 2. We start the journal entry by recording a debit to the cash account, if cash was received, or credit the cash account if cash was paid by the company. In addition, we must determine whether a gain or loss is associated with the disposal. A gain is recorded with a credit, just like revenue, and a loss is recorded with a debit, just like an expense account. Part 3. We complete the entry by removing the plant asset's cost from our books with a credit and by removing related accumulated depreciation with a debit. Let's see how we calculate the gain or loss associated with the disposal. Part 1. If the amount of cash received is greater than the book value of the asset, cost less accumulated depreciation, a gain is associated with the disposal. If the cash received is less than the book value of the asset, a loss will be recorded. When the amount of cash is exactly equal to the book value of the asset, there will be no gain or loss in connection with the disposal. Now, let's look at a specific example of a disposal of a plant asset. Part 2. Southwest Airlines sold flight equipment for $5 million cash at the end of its 17th year of use. The flight equipment originally cost $20 million and was depreciated using the straight-line method with zero residual value and a useful life of 20 years. We will use this information with a series of multiple-choice questions to give you some practice accounting for the disposal of a long-lived asset. Try to answer each question before advancing to the next slide. Part 1. What is the amount of depreciation expense that should be recorded at the end of the 17th year of use to bring the depreciation up to the date of sale? Part 2. The correct answer is choice B, $1 million. Annual depreciation expense is $1 million. Since depreciation expense for the 17th year of use has not been recorded, the amount should be recorded at the sale date. Part 1. After updating the depreciation, what is the equipment's book value at the end of the 17th year of use? Part 2. The correct answer is choice A, $3 million. Book value is calculated by subtracting the accumulated depreciation at the date of sale from the equipment's acquisition cost. The balance in the accumulated depreciation account is $17 million, calculated by multiplying the depreciation of $1 million per year times the 17 years the equipment was used before the sale. Book value is the $20 million acquisition cost minus the $17 million of accumulated depreciation. Once we determine the book value of the asset, we can calculate any gain or loss involved with the disposal. Part 1. Did the sale of the equipment result in a gain or a loss? Part 2. The correct answer is choice A, a gain of $2 million. To determine a gain or loss, compare the cash received of $5 million with the book value of $3 million. Since Southwest received more cash than the book value, there is a gain of $2 million. Part 1. Let's prepare the journal entry to record the sale transaction now that we have all the necessary pieces of information. Part 2. We record the disposal with debits to the cash account for $5 million and to the accumulated depreciation account for $17 million. The debit to accumulated depreciation eliminates the account balance. Next, we credit gain on sale for $2 million, and finally, we credit flight equipment for the original cost of $20 million. The credit to flight equipment removes the equipment from Southwest's books. Part 1. In general, natural resources can be thought of as anything extracted from our natural environment, such as coal, oil, and iron ore. Natural resources are reported at their cost less accumulated depletion in the non-current assets portion of the balance sheet. Part 2. Total cost, including exploration and development, is charged to depletion expense over the periods benefited. We use the units of production method to compute depletion expense. Part 1. We begin the process of calculating depletion expense by determining the unit depletion rate for the natural resource. The numerator of the equation contains the resource cost less any estimated residual value. The denominator of the equation is our estimated total capacity of the natural resource we expected to extract. For oil, we express the denominator in terms of barrels. For coal, we use tons. For timber, we use board feet, and similar measures for other natural resources. Part 2. When accounting for the periodic depletion of a natural resource, it is important to understand that the company obtains inventory from its mining or harvesting of some type of raw material. Thus, the amount of the total depletion cost for a period is capitalized as inventory, equal to the unit depletion rate times the number of units extracted during the period. Once in inventory, part of the depletion cost will be expensed during the current period through cost of goods sold as sales are made. This expense is computed as the number of units sold multiplied by the unit depletion rate. The unsold part of the period depletion cost remains in inventory until sold in a later period. Part 1. Intangible assets lack physical substance, and that makes it difficult to determine the asset's useful life or any residual value. Many intangible assets involve exclusive rights or privileges. We will review the major types of intangible assets and the related accounting procedures on the remaining screens. Part 2. Intangible assets are normally recorded at the purchase price plus any legal or related fees. Goodwill, trademarks, patents, copyrights, franchises, licensing rights, and technology are examples of intangible assets. We will briefly discuss each of these intangible assets. Intangible assets are normally recorded at the purchase price plus any legal or related fees. At purchase, we determine whether the individual intangibles have definite or indefinite lives. Intangible assets with definite lives are amortized using the straight-line method over the shorter of their economic life or legal life, subject to generally accepted accounting principles. Amortization is the same concept as depreciation, only we call it a different name because it refers to intangible assets. Intangible assets with indefinite lives are not amortized. They must be tested at least annually for possible impairment of value, and if impaired, the book value is reduced to fair value. Part 1. An intangible asset, called goodwill, can be created when one company buys another company. If the purchase price of the company is greater than the fair value of the net assets and liabilities acquired, goodwill is associated with the transaction. Unlike other intangible assets, goodwill cannot be associated with any specific right. It does not exist separate from the company itself. It represents the value of a company as a whole over and above its identifiable net assets. Goodwill may be attributed to many factors, including good reputation, superior employees and management, good clientele, and good business location. Part 2. Goodwill is not amortized. Each year we must test to see if there has been any impairment in the carrying value of the goodwill. If an impairment is determined to exist, we will reduce the goodwill account to its fair value and recognize a loss. Let's look at an example to see how we determine the amount of goodwill. Part 1. Arpec Company paid $2 million to purchase all of UTEC Company's assets and assumed liabilities of $400,000. The acquired assets were appraised at a fair value of $1,800,000. How much goodwill should Arpec Company record as a result of its purchase of UTEC Company? Part 2. The correct answer is choice C. Arpec Company paid $2 million for net assets with a fair value of $1,400,000. Since the purchase price exceeded the fair value of net assets by $600,000, Arpec Company will record $600,000 of goodwill. Part 1. A trademark or trade name is any symbol, name, phrase, or jingle that is identified with a company, product, or service. No other party may use the trademark or trade name without the permission of the holder. Many trademarks are extremely valuable. Trademarks have unlimited or indefinite lives and are not amortized. Part 2. A copyright grants to the holder the exclusive right to publish and sell musical, literary, or artistic work for the life of the creator plus 70 years. Most copyrights are amortized over a short period of time using the straight-line method. Part 1. A patent gives the holder the exclusive right to manufacture and sell an item or process for 20 years. A patent is amortized using the straight-line method over its useful life, but never more than 20 years. Most companies amortize patents over a very short period of time. Research and development costs that might lead to a patent are normally expensed as incurred. Part 2. Technology is a category of intangible assets that includes a company's website and any computer programs written by its employees. This category of intangible assets is rapidly growing on corporate balance sheets. Part 1. You probably can't drive down any major street without finding a number of fast food franchise operations. The holder of a franchise has the right to deliver a product or service under conditions granted by the franchisor. Any cost to acquire a franchise is amortized over the contract life of the franchise. Part 2. Licenses and operating rights grant limited permission to use a product or service according to specific terms and conditions. For example, you may be using computer software that is made available to you through a campus licensing agreement. Several items relating to the accounting for investments are reported as adjustments to net income in the operating activities section of the statement of cash flows prepared using the indirect method. These adjustments to net income are depreciation, depletion, and amortization are subtracted from net income. Gains on the sale of long-lived assets are added to net income. Losses on the sale of long-lived assets are subtracted from net income. Impairment losses are subtracted from net income. Purchases of long-lived assets result in cash outflows. Sales of long-lived assets result in cash inflows. These two types of cash flows are reported in the investing activities section of the Statement of Cash Flows. Chapter Supplement A. Changes in Depreciation Estimates. Part 1. The useful life and the residual value used in depreciation computations are both estimates. Like all estimates, new information may come to light that will cause us to revise our previous estimates. If the estimates do change, the book value less any residual value at the date of change is depreciated over the remaining useful life. Let's look at an example involving a change in both useful life and residual value. Part 2. Southwest purchased an aircraft for $60 million. The aircraft is depreciated using the straight-line method with a useful life of 20 years and an estimated residual value of $3 million. In year 5, Southwest changed the estimated useful life to 25 years and lowered the residual value to $2,400,000. Let's calculate the depreciation expense for the 5th year using the straight-line method with the new estimates. The depreciation expense for each of the first 4 years is $2,850,000. $60 million cost minus $3 million residual value divided by the original estimated useful life of 20 years. The accumulated depreciation for the first 4 years totals $11,400,000, computed by multiplying the $2,850,000 of depreciation each year times 4 years. The undepreciated cost, book value, of the equipment on the date of change is $48,600,000, computed by subtracting $11,400,000 of accumulated depreciation from the $60 million cost. The new depreciable base is the book value of $48,600,000 minus the new estimated residual value of $2,400,000. To calculate the amount of straight-line depreciation for each of the remaining 21 years of the equipment's life, we divide the depreciable base of $46,200,000 by 21 years. The resulting straight-line depreciation is $2,200,000 per year. End of Chapter 8.